In a few minutes. Settle down. Well, welcome back to Hotel Harry, everybody. For those of you who have not been coming to our meetups for too long, we used to meet here for a couple of years, but it became, ever since COVID and after that, it became very difficult to get a booking. But I'm pleased that we're back at a venue that seems to suit our needs best in terms of the space we have here and the AV facilities. So tonight, though, we're going to be talking about something which I think is, if it's not of interest to you now, because maybe you're relatively new to Bitcoin, it will be something that's worth keeping in mind for the future. And the point of what we're going to talk about tonight is a potential way, and we're going to be exploring this. I'm going to make it, I may as well make it clear about what we do at Bitcoin Sydney. We're not about necessarily promoting a product. You might see in other meetups, blockchain type meetups, where they have a sponsor for the night, and that sponsor is usually talking about their company or their project or whatever. And there's somewhat of a commercial, can be somewhat of a commercial conflict of interest there, because the organizer feels as though they really have to sort of talk up whatever that thing is, and not necessarily give you the full, all the sides of it, as to whether it is necessarily a good thing or not. So, but what we're going to be doing tonight is this particular project that, which I'll introduce Thomas later on, will be talking about, is a project, but it is nevertheless something that's built on Bitcoin. It's not built on crypto. It's not built on a blockchain. It's not someone trying to print their own money. It's not even a private company. These people are genuine Bitcoiners building a product on Bitcoin. Now, it may work, it may not. The idea of tonight is to explore it and to cover it, and you guys have the opportunity to ask the tough questions. As I said, we're not about shilling anything, and I know that in Bitcoin, things like this, even the whole idea of Bitcoin collateral loans, let alone smart contracts on Bitcoin, can be a controversial topic, and that's how it should be. And I think as well that what also should be your default assumption when it comes to any claim. In fact, even in Bitcoin itself, if you've only just heard of it, the default assumption should always be skepticism. And then if your skepticism is suitably assuaged by the explanations given by whoever's introducing the idea to you, well then you can go on and perhaps do something more with it. So that's very much what we're going to do tonight. I know that, as I said, a lot of people are very much, and this it can be a controversial topic amongst people that consider themselves Bitcoin maximalists, but at the same time I think we have to look at how is the overall Bitcoin ecosystem going to be built out. There are going to be people building things on Bitcoin, and either you bury your head in the sand and pretend they're not going to be there, or you take an active role in looking at them and making sure that these ideas are properly interrogated and scrutinised. So, what I'll just give a quick introduction for to set the scene before we ask Thomas and Rivers, who are from Rootstock and the Sovereign Project on, is just to set the scene with what Bitcoin collateral loans are. Now, many of you will be familiar with this already. I know a lot of the long-term members here will be familiar with the concept of this, but this is mainly for the newer members. But the point of a Bitcoin collateral loan is, and again, this is mainly at this point, someone who would want to, so a Bitcoin collateral loan is where you can essentially put your Bitcoin up as collateral. This is something, by the way, that wealthy people have been doing with their assets since whenever there's been reasonably sophisticated financialization of assets, and that is, instead of ever having to sell their asset and therefore pay capital gains tax on it, you can borrow against the value of the asset. And what would you rather be borrowing in? Well, you'd borrow in the thing which we believe is Bitcoin is ultimately going to be worth nothing, and that's fiat. And so the people that can right now, I think, best take advantage of something like this are people, as I've got in the slides here, who might have a reasonable amount of unrealized capital gains on their Bitcoin. I mean, I don't want to put too fine a point on it, but there are many people in this community who've got quite significant paper wealth in Bitcoin, but really don't feel as though, because they have a low time preference, they don't feel as though they can take advantage of that wealth that they have, because if they spend it, then what happens? Well, first of all, if you spend any of your Bitcoin, you want to buy yourself a new car, or basically live in the way that is somewhat befitting someone of that level of paper wealth, if you want to do that and actually get some benefit from it, you're going to incur GST for a start, which is essentially, you get a discount, but it's still potentially a quarter of the stack that you spend is going to be lost directly to the government. I don't think anyone here likes helping the government. The next thing is you're also going to forego, and again, we're all true believers in Bitcoin, so why would we want to buy something with it, like a car or something that you know is going to depreciate in value, and give up the thing that we all, I think, believe ultimately is going to be the de facto, best, world reserve currency, the ultimately take over as the primary money that people use in the world. And so the spending value potential of that money is orders of magnitude higher than where it presently is. So if you believe that, then the last thing you want to do is forego that upside by spending them now. And then of course there's the more community-minded altruistic reason for not wanting to spend up big, and that is, well, you're essentially dumping your coins on the market. Now, a lot of people think that the primary way in which what's keeping the Bitcoin price where it is, or keeping it down, or preventing us from reaching what's called hyper-Bitcoinization is the idea that, well, the newly minted Bitcoin, there's new coins being produced by the network every 10 minutes at the rate of 6.25 coins every 10 minutes. And those have to essentially be bought off the market. And so that's selling pressure. But if some of the discussions that I've had with a few Bitcoin OGs are anything to go by, I think that that selling pressure pales into insignificance compared with the selling pressure of these guys that have been around since 2011, 2012, buying themselves distilleries and hypercars and real estate and light industrial units and God knows what else. Believe me, I've had these conversations, and there's people around, they're so Bitcoin wealthy that they can comfortably afford to spend a chunk of it on those sorts of things. So that is putting sell pressure on the Bitcoin price, and is just further delays the ultimate victory of Bitcoin through what was termed many years ago hyper-Bitcoinization. I won't get too far into that at the moment, so we do need to get on with the rest of it. So, and of course the other person it's aimed to is you need to have, I think, a large enough stack of Bitcoin such that the amount that you're needing to be borrowing, the amount that you need to put up as collateral, isn't your whole stack. You don't want to be even considering any of what we're talking about tonight, if you are going to do it, with anything but maybe a relatively small percentage of your stack. You do need to be very careful. This is not a free lunch. I think there are drawbacks which we'll talk about, but one of the things you can assuage that is make sure that you are responsible with how much of your stack you allocate to this purpose. The main reason being is because liquidation is something that you worry about. If the value of the collateral that you've posted for any kind, this goes, by the way, for any form of Bitcoin collateral loan, be it through what we're going to talk about tonight or even some of the legacy solutions. You need to be able to top up the collateral if the Bitcoin price should fall. Because what you don't want to have happen to you, this is one of the big risks, is a thing called liquidation. So that's when the lender decides, or they don't decide, the price drops to a point where the value of the Bitcoin that you've got on the exchange no longer covers the value of the loan, or is no longer greater than the value of the loan. And so the lender will sell up your coins, usually at a very, like whatever the whipped down, low price that it hit. And of course you'll probably never get to buy your coins back again for that amount. And of course you'll end up then incurring the CGT, you'll forgo your upsides, and you'll have dumped on your fellow Bitcoiners. So it's important to have enough left over, plenty left in reserve, so you can always keep that collateral ratio nice and high and safe. So anyway, there's a couple of different types of ways of doing Bitcoin collateralized loans that have existed up until, well, there's the only main two ways of doing it up until now, which we'll talk about a better way shortly. And that is the most simple one, fully custodial loan. You simply transfer the Bitcoin to a lending custodian. What was one of the ones that did that? Was that, what did Celsius do? That was not that I'm putting them up as an example. HODL.
There's a 2 or 3.
Well, that'll be HODL was 2 or 3. Which one just did the fully collateral though? Was that BlockFi? BlockFi, there we go. So BlockFi is an example of a fully collateralized, you just transfer the Bitcoin to the lender, but of course then you have the risk, as we saw what blew up in other parts of, well, in crypto, and it did affect some Bitcoiners who might have done some of this sort of stuff. Risk of rehypothecation. That means that the person, since they've got the whole Bitcoin, they can then lend your Bitcoin out to other third parties. And so that makes the whole thing somewhat of a house of cards, so that if that lender fails because they've lent it out to other third parties that can't pay it back, then they've taken your Bitcoin with them, and all you've got is what you borrowed against with that Bitcoin, which is usually only up to maybe 50% the value of the Bitcoin. So that's a big risk there. There's a big counterparty risk there. The other type was, as I said, with the HODL, the 2 of 3 multi-sig, where you hold a key, so you keep one key, the lender has a key, and a supposedly neutral third party has a key. So that if there's a default from your part, then the third party can give the other key to the lender so that they can recover their, they can sell the Bitcoin and get their money back. Or if the lender collapses, you can go to the third party, get the key, and recover your coins. Now, and of course I think, and well, we can talk, now one of the problems that all of these things had, of course, is you are giving up custody of your Bitcoin. It's literally on our sign here, not your keys, not your coins. It's one of the most important aspects of being a Bitcoiner is self-custody. Catan does some great work on that front. He's got some great guides for keeping your own Bitcoin, not leaving it on exchanges, not leaving it with third-party custodial services. And unfortunately, to some extent, especially with the fully custodial, the fully custodial option I mentioned before, you are giving up custody of your Bitcoin. And so, of course, that has the risks that I mentioned earlier with what can happen with those counterparties, fraud, bankruptcy, so forth. The other issue I've noticed with those is I think, well, in my view, I think the interest rates for those products have been quite high, considering that the risk is completely borne by the borrower. Remember that you are posting as collateral far more value in Bitcoin than what you're borrowing back, than what you're borrowing from the lender. So the moment, for whatever reason, the collateral that they're holding no longer covers the value of the loan that you've taken from them, they just sell you Bitcoin and they're made whole. So there is absolutely no risk on their part, but there's risks to you, of course, as the borrower, that there could be a dip and you get your coins liquidated. So hence this one here, you could be easily scam-whipped. I think if you've ever looked at a Bitcoin price chart, you'll see that occasionally what can happen is there could be a very, very sharp down spike. Very quickly the price could drop but then rebound back up. But what if the lender was using that price chart to say that's the price that they've decided that they're going to liquidate you on? They liquidate you down when it's just touched the bottom. It's there for a fraction of a second. So that happened to a lot of people in the past. And then, of course, there's the duration of the loan. It's a fixed term loan. You then have to go through a procedure to either renew it or take out another loan again. So, of course, Bitcoin was designed to essentially solve a lot of these sorts of problems, particularly counterparty risk, the need for trust, all of these sort of things. And it certainly solved it in terms of money. But the next question is, can it also, or can mechanisms built on Bitcoin solve some of the problems I talked about tonight in a way that's consistent with Bitcoin's raison d'etre? So, can we do lending? Is there an equivalent thing with lending? Can it perhaps be done in a way that solves the same problems with lending as what Bitcoin solved with money? Particularly if it's built completely on Bitcoin and falls in line with many of Bitcoin's founding principles. And then if it is, are there still any risks? That's what we hope to go into some detail and really get into the meat of tonight. What are the risks? And are those risks manageable and acceptable? So that's all I had to say on that, to set the scene. I hope that makes it clear to everyone what we're going to be talking about tonight. So I'm going to hand over to Thomas. Thomas is the Rootstock Ambassador. Is that right? Would you consider yourself the Rootstock Ambassador for Australia?
Yes.
Yeah, that's the right word. Yeah.
I think that would be.
And has been working with Sovereign, which is the Bitcoin lending product.
Yes. Yes.
But Rootstock, just to again set the scene for that. Now, obviously, a lot of you here are familiar with the idea of smart contracts on Ethereum. Is the most well-known of these smart contract blockchains. So, of course, Ethereum, though, doesn't know what it is from one day to the next. One day it's money, one day it's a world computer, one day it's this, day, you know, it's essentially very much a centralized thing nowadays. It has essentially what would you call it, a managing committee of people that just decide what the policy is going to be. It claims to sort of follow in the idea of what Bitcoin can do, but it loses so much of the most important principles of what Bitcoin was supposed to be. So it can do smart contracts, which are much more sophisticated type of financial mechanisms on its blockchain. But it does it all directly on the base blockchain and therefore compromises the very things that made blockchains and Bitcoin, for example, which it originally sort of stemmed out of, useful and interesting in the first place. Now, Bitcoin, though, can do smart contracts, but it does it in a way that doesn't interfere with with Bitcoin itself. It does it on a separate, if you think of it like an abstraction layer, it sits on top of Bitcoin, and you execute smart contracts in there without compromising what the bottom layer of the main original bottom layer of Bitcoin is doing. So that's what Rootstock is. It's a sort of a smart contracting, sits on top of Bitcoin, and then allows people to do these more sophisticated financial mechanisms on top. So I'll hand over to Thomas, and he'll tell you about the rest of it. And of course, I should mention, we've got Rivers. Can he hear? Can Rivers hear yet?
I think so.
Can Rivers hopefully hear us? We've got Rivers online. Where's Rivers dialing in from? He's dialing in from...
I think he's in the UK.
In the UK? So welcome Rivers, if you can hear me. Rivers is also working with the Sovereign Project and will also be helping answer the tough questions, which we hope we'll get. Yeah. All right, terrific.
He came for a little bit of technical support in case questions get a bit too out of my scope. So, before we start, has anybody heard about Rootstock before? Yes? No? Okay. So yeah, basically like JP just told you, Rootstock is another blockchain that sits on top of the Bitcoin blockchain, because all this stuff that we want to do, we don't want to have it directly in the Bitcoin blockchain, because that would cause another series of issues. So I was going to go straight into the Sovereign protocol. Just to give you a brief idea of who I am, I was born in Argentina. We had a lot of financial difficulties over there, as you might have heard about. And it may not surprise you that Rootstock got started in Argentina precisely for that reason. For us, it's very difficult to access dollars, it's very difficult to access financial services. So this provides a very important solution for us, but also to a lot of Bitcoiners around the world. We can see, as soon as we enter into the website, that there's over 2,000 Bitcoin locked in the system. If you're gonna look for it, Sovereign is spelled a little bit weird with the R-Y-N. And it's one of the biggest protocols running on Rootstock at the moment. Rootstock was launched in 2018, so it's been going on for a while, very undetected by most Bitcoins, so I'm not surprised when I ask the question that not many of you raise your hands. Before we go into Sovereign, it's very important to understand that Rootstock was thought out from the very beginning to be very aligned with Bitcoin. So, for example, many other blockchains, almost every other blockchain, release their own token. And that, from the get-go, puts you at odds with Bitcoin, because you have to choose, do I use Bitcoin, do I use this other token? In Rootstock, you use Bitcoin. It's again, you cannot use Bitcoin directly, so you have to go through a bridge, but the main token and the one you use to pay the fees is collateralized one-to-one to Bitcoin, and the fees get paid to the Bitcoin miners. So everything you do on Rootstock helps the Bitcoin miners make more money, so that means more security for the main chain. And the growth of Rootstock implies also growth on Bitcoin and vice versa. So they're very much aligned and they're not competing towards each other. So let's go into it. So the first really cool thing about Sovereign is that you can use your hardware wallet directly. If not, you can log in with other common Web3 wallets. Okay, so there you go. You log into your wallet, and we're gonna test the protocol 0, which is the collateralized Bitcoin loan. The website Sovereign, you will see it's still on alpha. It's been around for 2 years now, and it's about to make the jump from alpha to the next stage. 0 itself is very new protocol, and we're gonna go through a bit of a change in how it looks for when it's open for everyone. At the moment, if you want to use Zero, you have to sign up with your email, and you go into the waitlist, and then you can get accepted. But we're very close to just opening it up for everyone to use with your wallet, with no sign up, no nothing. If you want to remain anonymous, you can just make up a fake email, use it, get in. What is it with the delay? Okay, has anybody used any DeFi application? Are you guys familiar with this kind of technology, or is it all new?
I imagine it would be all new because this is not something that normally.
True.
I guess the thing with Bitcoin is it's more about it's just money, right? You hold your money.
Very true. Very true.
So perhaps you might want to backtrack a bit and just explain perhaps what the difference is. With the scene I said there before, perhaps what's the difference with Sovereign? How it's different to those other protocols or not protocols, but the other products I mentioned earlier in terms of for doing Bitcoin-backed loans. Yeah,
it's true. The main difference I see with Sovereign from all the other projects is the fact that everything is thought out from the get-go. Everybody working on Sovereign is a Bitcoiner, and they're trying to build services to take you away from centralized exchanges, and that is completely aligned with Bitcoin, and it drives value back to Bitcoin. Like we said before, everything we do on Rootstock, everything we do on Sovereign brings value back directly to Bitcoin and the Bitcoin miners specifically. There is a lot of problems with the way things are done in centralized, what we call TradFi, traditional finance. Mainly the fact that you have no way of knowing what's happening behind the scenes. Like we saw with FTX, they can tell you, oh yeah, you bought Bitcoin, you have this amount of Bitcoin, but that's just a number in an interface. That you have no real way of proving that you have this Bitcoin there in reality. And then you're accepting a lot of risks that you're not aware of, and they're trying to obfuscate that fact, and it can turn bad in a second without you knowing and being able to do anything about it. One of the first things you'll see in Zero is this tab. This is a very important tab. It shows you everything that's happening. Everything is in the blockchain, 100% transparent, and it gets updated in real time. And this is key difference between everything, because now you can judge. Is there risk? Is there not risk? Do I want to stay? Do I want to move? For example, we'll see, we can see how much Bitcoin is in the system. This is almost 700 now. It's been launched for a few months only. It's having incredible growth. And technically, I don't have the contract addresses at the moment, but if you go to the contract address and you put it in the block explorer, you will find these Bitcoins in there. And it can be verified, and there's a lot of people that are constantly verifying it. That's part of the Bitcoin ethos, don't trust, verify. And like I said, we're all Bitcoiners trying to find new use cases for Bitcoin. We can see, well, basically, you put Bitcoin in, you get stablecoins out. These stablecoins are backed by this Bitcoin, so at any moment you can redeem them back for your initial collateral.
Would you mind just maybe clarifying that a little bit for people? How you say put it in?
Yeah. Also, sorry, I will say this is my first live presentation. Okay. I'm a bit nervous. I usually do these kind of things through Twitter Spaces and stuff. So if there's any question, if I'm going too fast.
Yeah. So I have a Bitcoin wallet with one Bitcoin in it.
Yes.
What are the kind of experience that I'll have to get a loan for some amount of US dollars for that one Bitcoin?
All right. Well. Yeah, let's take it back. The first thing you'll need to do is go to Sovereign. You go to this tab where you'll find your wallet address. So you need a Web3 wallet.
Web3 wallet. Is that a rootstock wallet, or is it again, most people here haven't done any of this kind of smart contract stuff. They've just got their hardware wallet.
Have you guys heard of the wallet MetaMask? It's one of the most popular wallets that people use for Ethereum and stuff.
Yeah.
So MetaMask works on Sovereign, you have a lot of other options. I personally don't like MetaMask. I use Liquidity, which is an open source, and I think it's much better.
Can it be done with like a wallet that's not so? Because I mean, MetaMask is pretty much on your computer, and it exposes potentially your private keys.
Well, yeah, like I showed before, you can use your hardware wallets. You can use a Ledger. I use a Ledger at home. I didn't want to bring it here.
Yep.
I don't want to take it with me.
Yeah.
It's still interfaces with your browser.
Yes, yes.
Yeah.
So far you have to use your browser. There's been work done to get a mobile app. I know that's very huge for getting more adoption, but there is not yet a working mobile app.
Okay, so I've installed that thing. What is
Yes.
the next step?
The next step. Okay, so you have your extension browser, you connect it, then you go to Portfolio, and the first thing is you need to get your BTC into the Rootstock network and convert it into an RBTC. RBTC is collateralized one-to-one with BTC, and you can at any time go back and forth. So if I click here, Receive, I can then send Bitcoins through the Bitcoin network and get RBTC. And you can do the same thing backwards.
And what's it going to look like when that? What will the Bitcoin transaction look like that does that?
Okay, let's take it down.
I'll send to an address. So
Yes, you generate an address. Remember that you already logged in with your browser wallet. So
Okay, so we verify the
yeah, you get a QR code. You send your Bitcoin there, and you will receive it in your wallet as an RBTC. And then to do the opposite thing is pretty much the same.
And that address is owned by the operators of Rootstock, or
The address is your address. It's your wallet.
yeah.
This is called the Fast BTC bridge. So that bridge was built by Sovereign. There's other bridges that different projects built.
Right. Okay. Yeah. Nominally, it's my wallet, but on the Bitcoin blockchain, that Bitcoin address must be owned by someone else.
Yes. That Bitcoin wallet goes into a multi-sig owned by. It's a federation, but the federation is built in a way that it's very interesting. So there are many of these kinds of federation, like the Liquid network has its own. This one, I like it, it's very particular in the way it's done because the members of the federation don't have the ability to mess with the way the system works. They basically have what's called an HSM, it's a hardware security module, and they cannot mess with it. Everything of this hardware and the software is open source, it can be verified, and the only thing they can do is they can turn it off. They can turn it off or turn it on. That's the only ability they have, and this hardware are distributed around the world, and we are trying to move towards a completely trustless bridge. Right now, it's not possible, and this is the best solution for now. But that's a very good question. So, and yeah, you can also check on the blockchain Bitcoin Explorer that this multi-sig wallet has all the Bitcoin that it claims to have.
And then then that's my address on. That's only a Bitcoin network address. On Rootstock, I have a different thing, and I have an account or something on Rootstock, and then my account gets credited.
Yes, but your account is your own wallet.
Yeah, my account with my key or my wallet gets credited because that software in the browser is told that thing at this address you got to give, or money that goes to this address will go to this account.
Yeah.
On the Rootstock.
Yes. And we are now seeing the first kinds of wallets that have both Bitcoin and Rootstock in the same wallet, and they allow you to do transfer between them.
Cool.
So that's also another cool thing that will make all this easier. Because for now, all this is very new, so it's still a little bit. It's not as the process is not very streamlined, and it will get easier and faster as we get to work more time on them. So yeah, you do this to get your Bitcoin, and then in Zero you can put your Bitcoin collateral to get the stablecoin that keeps the value with the dollar.
It said 1.5 hours on one of those slides to wait for it to sync up. Why? That would make me nervous. Why 1.5?
I did a transfer this morning and it took less than 2 minutes.
It's just on one of those screens.
Yeah,
it
yeah.
Take up to 1.5. I just wonder. Usually Bitcoin, it usually transfers are supposed to be immediate. Why's the caveat there?
Every time I used it, it took as much as a normal Bitcoin transaction does. I think that space was there as a precaution, like, hey, if it's taking too long, contact us. We'll make sure.
That would scare me for a minute, because I would think, well, it's a 10-minute, and then you're
well, it's not. I mean, 10 minutes is just the average.
Right.
I mean, a Bitcoin.
Well, also, it depends on how much feed. If you're at the bottom end of the
right.
When's that going to come from? Right. Could take an hour. Could take 3 days.
And that's
where they're allowing for that.
Yeah.
And even if you get it in the next block, it's not unknown for the next block to be an hour away or 2 hours. That has happened in Bitcoin's history. The average it aims for is 10 minutes.
Okay.
But you can get a block immediately after the next one, or it could be an hour after the next one. It just averages to 10.
That's a helpful.
So they're levying.
Yeah.
You can also want to wait more confirmations.
Exactly.
Yeah.
They might want
Crediting you on
6 instead of just 1.
Yeah.
Yeah.
So it's actually concerning for me that it's so fast, actually. It should be slower, given what's actually happening behind the scenes, in my mind.
Right. Yeah, but that's one of the most common questions we have to ask we have to answer in our channels.
Okay.
Yeah. One thing that I will ask anyone that is interested, at least a little bit in this topic, is to join the Telegram channels and be part of the conversations, because we're trying to build a financial system on top of Bitcoin that we think is going to drive a lot more value to Bitcoin. And we like more people to contribute, tell us what needs to be improved, why something is not as good as it should be, and be part of the conversation to try and build this thing that, if it continues to work as it's working right now, and if it delivers on the promise, I think it could be pretty good for Bitcoin, because if you think like how the loan works, it drives a lot of demand for Bitcoin to be locked, in essence. And that, I think, is helpful for Bitcoin to not be as volatile.
I think that anything that gives people less reason to sell or spend Bitcoin can only help Bitcoin achieve its ultimate victory over fiat.
Yeah.
Of course, though, with the caveat that when it gets unlocked in a liquidation, then it gets flooded onto the market, so it makes it a hyper-fragile kind of thing.
We'll
which is
talk
an
about
caveat that we need to talk about. Yeah.
Yeah, no, we'll definitely talk about liquidations.
Well, I would like to ask a question on liquidation. Probably the most crucial thing is who decides when the liquidation happens.
Yeah, well, we can go into that now if you like. This is all with, like we said, with smart contracts. So the idea is you have all the information completely transparent, and you can verify it yourself, and you know the rules getting in. And the idea is that the smart contract will work consistently, and then you will have no surprises. So the basic rule is, you'll see here this number, 197%. That's my collateral ratio, which means the difference between the Bitcoin locked and the debt, which are all the stable coins that I took out, against my Bitcoin, is almost 200%, which means that for every dollar I have here, I have almost $2 worth of Bitcoin. If this number drops below 110%, that loan will be liquidated. And then what would happen is I will lose my Bitcoin, I will lose my debt, but I will keep the stable coins that are in my wallet. So in that case, I wouldn't lose everything, I would lose 10%.
You'd lose the 1/11th, yeah.
Yes.
Yeah.
Yeah. And I could then, if I want, use the stable coins to buy more Bitcoin, and I would be 10% down. There is another thing that is good to.
So that's, sorry, by the way, guys, in case you're wondering, because what hasn't been mentioned yet is the fact that you're essentially borrowing money interest-free here.
Oh, yeah.
That's an important point.
Yes.
I think people are going to really want to know, how is that possible?
Yes.
This sounds too good to be true. It seems to tick every box: interest-free, no term on the loan,
Yeah.
I think people are going to really want to know that mechanism, how... There's not a free lunch, and I think you've just mentioned what the cost of that lunch is. Is the potential loss of that 111 should you get liquidated.
Yes, yeah. So one of the, again, breakthrough things here is that because you are depositing the Bitcoins and this loan, these dollars are being created when you deposit your Bitcoin in and you decide how much you take out. So there is no borrower. You're both loaning against yourself. Yeah. So there is no interest. The only thing you have to pay is when you create the loan, you have to pay an origination fee, which, depending on how healthy the system is, will oscillate between 0.5 and I think 1.5 is the highest it can go. But you pay that, it's a one-time pay, and then you can repay your loan whenever you want, and there is no interest. So, for example, I could leave this, have a Bitcoin there for the next 10 years, wait until it keeps growing in value, and then I will only have to return this amount of stablecoin to get all my Bitcoin back, regardless of how much it grew up, without having to be paying fees. And I can repay my loan at any time that I see fit, or just leave it there and keep borrowing against it as my Bitcoin grows in value. That's the idea. Going back to the liquidation thing, and there's important to know that right here we have the total collateral ratio of the entire Zero protocol, right? So calculating the amount of RBTC locked in the Zero protocol right now is 12.2 million. The amount of stablecoins issued are around 6 million, so it's a little bit less than half, so it's 189. If this number, 189, were to drop below 150, the liquidation ratio would go up to 150. So in that case, more people could get liquidated, but if you do, you will only lose 110%, like in a normal liquidation.
Thomas, if I may.
Yes, please.
Hello, everybody. You know, I've been working on this project for the last year, and it's been a really nice experience. First of all, you know, we like to think that we're building this software for ourselves. And we're the users. You know, Thomas is using that, I'm using that. I actually recently bought a property, and I was very silly because I didn't account for the tax I had to pay when buying the property, which tended to be higher than I expected. And basically, I had to organize some funds really quickly, and the banks were really operating. They were telling me, okay, you've just taken a mortgage, you don't really have a credit score to get any additional funds. But I had my Bitcoin, and I said, okay, I'm going to put it in Zero, and I'm going to give myself a loan. And that was like a use case where it actually saved me, you know, a butt, because I could get the money, and I could hit tax, and I could get the property, finalized transaction, and I didn't have to sell my Bitcoin. So in this sense, you know, what we're talking about now, the event of liquidation, yes, you know, you have to be careful. You're the master of your loan, so you need to be like my advice is just to not to be too greedy. Don't take a super aggressive loan against the Bitcoin. If you're taking a loan, make sure your collateral ratio is healthy. I'm personally keeping it well over 180%, so higher than the total collateral ratio in the system. To me, this is the benchmark, and this guarantees that even if if suddenly we have another FTX or another Terra Luna collapse, and the price of Bitcoin tumbles to, I don't know, 12K or 10K, and the total collateral ratio would go to under 150%. This is all programmed to trigger so-called recovery mode. which means that additional loans against the lines of credit are being paused until the total collateral ratio goes back to over 150%. Again, the safest thing to do is just not to be too greedy. So leave some space, leave some margin, before this level. Personally, my collateral ratio stays between 180 and 200%. And so far, no matter what the price jumps were, it actually, I don't have to worry about that. I can always either pay back some of the loan, I can pay back some of the collateral, or top of collateral, or pay back some of the loan. So there are two ways to manage your collateral ratio here. You can either repay the loan that you've taken, or you can increase collateral, or you can do both at the same time in a single transaction as well. Thomas, I'll let you continue with that. If you guys have any questions, I'll be more than happy to answer. Long story short, don't be greedy with your loans. Don't be too aggressive. It's a smart tool. It's a new tool, and it's the future of finance. The most important thing is that nobody's going to ask you, what is this money going to be used for? Which country are you based? Can you do a KYC? Can you show me which passport you have? Or do you have a good credit score? This is the true financial freedom, where nobody is asking why you need this money. You're the master of your own wealth. I'll leave it here and have to pick it up later on.
We have a couple questions.
Yeah. So hi. What's your name?
Rivers.
Rivers. Yeah, Rivers. I'm really
interested in this. So I was interested in how you solved your personal problem without going into too many details. You got yourself a loan, but then from that loan you get ZUSD, right? Or ZUSD, yes, probably is the correct pronunciation. What did you do with that in order to actually pay the tax or what have you? Because obviously I don't know any bank that's accepting ZUSD.
Yeah, well, that's the issue you're gonna have with every single stable coin, even if it's just USDT, Tether. If you want to cash it out to a bank, you're still going through for a regular crypto to fiat transaction. And in my case, it was no different. So I've taken ZUSD stable coin loan. I had to cash out to Bitcoin, sell Bitcoin, go for exchange, and put the money in my bank. So it's.
But I suppose
the regulation.
If I could just add, so I suppose the difference. So you took the ZUSD, converted that to more Bitcoin, and then were able to convert the Bitcoin to dollars on any exchange, if I understood that correctly.
Correct.
I
yes.
imagine, therefore, that because the buy price of that Bitcoin on the exchange is pretty much what the sell price was, it wouldn't be the same as selling the original Bitcoin. It's just that you're only selling the Bitcoin you just received, so therefore there's no capital gains tax or anything owing on that little bit of Bitcoin.
And that's how I felt it too.
Yeah, I just wanted to I was mainly making that clear to the audience rather than necessarily asking you, but
you avoided capital gains tax.
Yes.
Is that the key thing?
Well, yeah, that is one of them. I don't think it's
one of the use cases.
Is there anything else?
Yeah.
Well, I just mentioned in the beginning all the things.
No, but in this case.
Yeah. For example, I'll tell from my own personal experience, this amount of dollars that I took, I used them to pay rent, buy groceries, and I didn't have to sell my Bitcoins. I still have my Bitcoins there.
Now I think another.
So not losing your Bitcoin exposure.
Yes.
At all, putting it some at risk.
Yeah.
Liquidation, but not you losing exposure in the
yeah, and you're keeping an asset that you're hoping is going to go up in value, and you're using one that you hope is going to go down.
Yeah.
So
it's like basically, if I'm thinking about this financially, what I'm doing is I'm going leverage. So
if I'm thinking about this financially, what I'm doing is I'm going leverage long Bitcoin in a similar to like one way you would set up this up is go to BitMEX and take out a long position and sell some Bitcoin, right? That's like getting the same exposure. So it's like setting that up, except with more verification of where the money is held during that process. Yeah, that's
no KYC.
No KYC, and then okay, so I'll let the other person ask a question first.
I think there was one back there.
Yeah.
Just when you open or close a line of credit or adjust.
Take the mics over. Yeah.
When you open a line of credit, close it, adjust it, does that get published as a transaction to a blockchain that's publicly?
Yeah.
So on the sovereign blockchain?
And the rootstock blockchain.
Okay. Just because I'm thinking then people could figure out where you get liquidated, like based on the time and the price. If it wouldn't be a problem if the market was small, but as it got larger, then it would be a place to put a sell down to. Do you know what I mean?
So you're saying if someone puts a lot of Bitcoin collateral, someone might try to bring the value of Bitcoin down?
Yeah, I mean it happens in DeFi, like they're looking for.
Yeah, that's another good reason why it's a good idea to have a lot of collateral against the amount of dollars you take out. It's always better to be safe than sorry. But that's one of the, I guess you call it a drawback of transparency.
Yes.
And it's a choice that we have to make. Okay, any other questions?
Yes.
Okay.
There's the crucial question. I asked earlier, but it wasn't actually the answer I was looking for. It's like,
so I asked this question earlier. It's like who decides when you get liquidated, right? You said, it's a smart contract. Okay, that's fine. But who decides? Who tells the smart contract what the price is? So they decide. So who's the oracle?
Okay. Rivers, did you hear that question?
Was that around which oracles we use?
Yes.
Okay, well, we use, I think we use two oracles. One is Chainlink, the other one, I think it's a rootstock specific one. The price, I think, generally to manipulate Oracle, there's been some attempts to exploit this to change the prices of different tokens in the oracles, but it's super hard to do, and we are trying to have a backup always for that. So there's a double gate to check the price twice. I don't see that as a major risk. I think it's pretty safe to say that with two oracles, both being 99% times correct, it is going to be, you're not going to get liquidated because of some manipulation. The only case where you would get liquidated is if you were super aggressive, so you would take a big load against your Bitcoin, with let's say going to collateral ratio of 115 or 120%, and then if the price of Bitcoin drops significantly and you fall under 110%, you would be in a risk of liquidation. That's pretty much the only scenario where you would be liquidated.
Can I just ask a follow-up on that? Rivers. What has been known to happen in Bitcoin in the past is what are called flash crashes, flash wicks, or scam wicks, as some people call them, where, just so the audience knows, it's a very brief dip to a very low price. Maybe you get a whale, fat fingers an order, or something like that. What would stop? Is there some sort of time smoothing function, perhaps, that prevents that momentary dip to some ridiculous price that no one really was ever able to exploit if they were buying? Stops that price being used to trigger liquidations?
Yes. So again, if there was some kind of flash crash in price, and this would be applicable to everybody, right? So every single line of credit would, every single collateral ratio for every single line of credit would decrease. So that's why we programmed the algorithm to have the total collateral ratio of 150% as a buffer. And if it falls under 150%, then the system automatically goes into recovery mode.
Oh, I get that. Yeah, but occasionally you can get what happens if there's literally a wick that just wicks everybody out for 1 second and it puts it down below the 110% for a whole bunch of people? What's to stop it? A price that isn't a real price. It's a price that happens sometimes on an exchange, as I said, with a fat finger order. And if that exchange happens to be what's linked to the Oracle, is there some way, something sort of algorithmically that stops this price that no one ever was really able to exploit, as I said, but it gets used for a fraction of a second to trigger a whole bunch of liquidations. You know, buffers notwithstanding, because these flash wicks can often be, like, as I said, very momentary and can cause a drop of, you know, double-digit percentages or more that last for a second and the price is back where it was. It has been known to happen in Bitcoin, and I'm just wondering whether or not there's a risk, if that's a risk. And is there a way of mitigating that risk in the sovereign system?
Yeah, well, you know, one of the, I think realistically what you're talking about is something, you know, it's information coming from Oracle that caught some different price, right? Because the price fees are being fed by Oracle.
It's like it's a real price, but the price is like the price is so brief that no trader is ever really able to buy it at that. But it nevertheless gets recorded in the Oracle and could trigger an instantaneous liquidation. That's why, like, some products have what's called I think it's called a mark-to-market function, whereby they don't go by the instantaneous, they don't react to the instantaneous price of the coin. It's averaged out over at least the course of a few minutes or an hour or something like that. So it's like little momentary flashes down, you know, with big percentage drops, are essentially smoothed out of the price that the smart contract is using.
Yeah, well, in case of, you know, Sovereign is being very blockchain centric, so we will be looking into things that got recorded on the blockchain. So, you know, something that lasts microsecond or a second is not likely to be captured in the next block. So, you know,
okay,
we're using
there's like a sampling interval. So the blockchain has a sort of sampling interval of the current price. It's not literally being kept up to date every nanosecond. It has a certain refresh
yes.
rate. Okay, all right, that's a way around that. Yeah, what is the refresh rate? If someone asked you what the refresh rate was.
Is it every block?
So in terms of Bitcoin network, there will be, you know, the sort of 10 minutes when the block is mined. In terms of Rootstock, it's a little faster. I think it's going to be around 30 seconds.
Okay, that would smooth out those flash dips, I think. Yeah, no, that answers the question.
So you sample the price every 30 seconds?
Can you please repeat?
No.
So do you sample the price every 30 seconds, like every single Rootstock block? Or you do it once an hour or something?
Around that time. You know, it's pretty much as much. I mean, the oracles are working faster than that. The Rootstock transactions take around that time, take around 30 seconds.
Yeah, I think
occasionally they're fast.
And maybe if people are hoping for another event, we can bring someone that works on the oracles.
Yeah, sure.
To give a more detailed answers to all the questions. So I think he was first.
Yeah, hi. I'm just trying to understand exactly why you require a blockchain rather than just an SQL database to run your software.
Why do you require blockchain rather than?
Yes. Why do you require a blockchain? Why does your system require a blockchain?
Why a blockchain and not just an escrow service?
Well, because we're not centralized. We're not, you know, these things don't happen in any centralized entity. You're interacting through an algorithm with the protocol that we built. The protocol is decentralized, so you know it's a DeFi.
Yeah, I think just to sort of clarify, just for Rivers, yes. I mean, that is a question I often ask myself, and a lot of Bitcoiners ask is, yes, why use a blockchain? And most of the time, most people who produce things on other blockchains like Ethereum and so forth don't have a very good reason for using the blockchain because they've got huge centralization points. So, what are there remaining points of centralization with the sovereign protocol, or is this something that eventually it can be, once its development is complete, it can essentially be let to ride in the wild, and that therefore, once that's out there and it's running, it's not subject to the influence of a small group of people like many other blockchain-based or unnecessarily blockchain-based projects are. Sorry, that was a bit of a... I can see how that question didn't... it was a bit confusing.
It's a good question.
Sorry?
It's a good
Did
question.
it make sense? Sorry, did the question make sense, or I'll rephrase it if it didn't?
Yeah, I think
To what extent... Okay, I'll just summarise it right down. To what extent are there any centralisation points with Sovereign, and perhaps you could also elaborate what centralisation points remain with the rootstock protocol upon which Sovereign is built?
Sure. So I think you know, I would say that most of those things that are that can be manipulated, as Thomas said, manipulation pretty much means turning something on and off, because there isn't, you know, everything's encrypted, so there isn't any sort of back doors as it was in FTX or something like that to manually you know, type in values and do anything like that.
There's no like admin keys. There's no admin keys or that sort of thing. It's sorry, I was going to say there's no, like, a lot of these protocols have admin keys where essentially the developer has just got the ability to override the entire mechanism, which again, that really would defeat the purpose of putting something on a blockchain when you have those sorts of centralization points. So yeah, are there any things like admin keys or similar things where a small group could essentially change the protocol or change the rules of the network in someone's favour, anywhere in the Sovereign system? Yeah.
No, that's not how it was designed.
Who gets the origination fee?
The origination fee goes to Treasury, to Sovereign Treasury. So as you probably know by now, you know, we launched Sovereign Zero as a 0% interest. So you know, it's the loan you can give yourself with no interest, and there is the origination fee that goes to back to Sovereign Treasury. You know, we are a distributed collective. There's around 40 people working on Sovereign protocol right now, and we do have our token. It's a governance token, so you know, we use that to make SIPs, sovereign improvement proposals, and we have you know, we reward our stakers. Again, as the organizers here mentioned in the beginning, you know, the Bitcoin world is very, you know, the spectrum of Bitcoin world is very wide. There are some toxic maxis that would, you know, just stack sats for their grandchildren and never spend a sat and never use it, and you know, I don't see much point in living a life like that. There are others who would, you know, work smart with their Bitcoin, use it to their advantage, and use different tools to do so. Sovereign, you know, we started in, you know, the project around 2 years ago. I wasn't in the project at that time, but history of Sovereign is that, you know, we started with an ICO. We had our token. We had liquidity mining features. There was yield generation, the classic DeFi on Bitcoin. And you know, I think, you know, right now the sentiment is that, okay, you know, DeFi, NFTs, these are the bad things. I think this, you know, we're in bear market. A lot of people get wrecked. There will be a way where this will turn around, and you know, everybody's situation is slightly different. So there's still a lot of maxis around us, and still people who treat only Bitcoin as the one and only token. But you know, we've got some other utility features on the soft token that some people decide to use. Like Thomas and I, we hold some softs because they, you know, these tokens allow us to participate in a governance system called Bitocracy. So we've got a decentralized way of voting, of submitting proposals, and yeah, that's how it works.
Okay, sorry, just on that. So yes, I did understand that. Obviously, the group you're addressing would be very much consisting of those sort of maxi people, but at the same time, some of us are also willing to see other things built on Bitcoin. As for the token, I think though, can you just confirm that the governance token you refer to, it's not necessary for that, its value in any way or the existence of that token has no effect on anyone's ability to actually use the protocol though, does it? Is there any, this is an entirely separate thing that people need?
Absolutely. You don't need to know about the token to use the protocol.
So I think, sorry if there's any more questions, but I think the burning issue then people would want, would sort of have to circle back to is maybe learn more about how the mechanism maintains the value peg. So what is it, what's the US, the stable coin, what's the, it's ZUSD. So perhaps we could tell us more about what mechanism maintains the value of the ZUSD and how that ties back to the other points we've talked about.
To be honest, I don't think I'm the best person to be explaining that. You know, we designed the ZUSD, or something that soon be rebranded to DLLR, sovereign dollar, to basically take the value of Bitcoin and to measure from the Oracle to measure, you know, how many dollars are in a Bitcoin. Right now, the plan is to maintain the value of the sovereign dollar as 1-to-1 to US dollar, of course. However, we did have a conversation about pegging to something different, or, you know, having some thoughts on what will happen in the future if, you know, the price of US dollar starts collapsing. We're looking very much, you know, out to the future, and want to make sure that, you know, that there will be some way to be future-proof.
I think that if the US dollar collapsed, that would be a very good thing for people who borrowed US dollars. So I don't think anyone would be worried about that. But I think the question I think people would have is, you've staked your, you've wrapped real Bitcoin into the system, onto Rootstock, and then for that, by putting it up as collateral in a sovereign loan, you then get issued ZUSD. The question is why is the ZUSD equal to the value of a dollar? What's the incentive mechanism? What's the game theory that keeps this token that you've essentially minted out of thin air? You've been able to mint that yourself through the smart contract. You've created that ZUSD.
Well,
where does it derive? Where's the counterparty, the exchange for where I take that ZUSD, I take it to my local exchange and get a real US dollar or Australian dollar for it, so I can pay my water bill. Why is someone buying the USD off of me? What's the mechanism there that keeps that ZUSD worth the same as an actual USD?
So, you know, I think it would be easier to explain that based on the other stable coins out there, which are not backed by anything. Here you've got your ZUSD or DLR backed by Bitcoin. The price of Bitcoin, you know, it's easily checkable. The Oracle dictates the price of Bitcoin and divides it into multiple ZUSDs. So, you know, in this sense, I think, you know, the sovereign dollar is superior to Tether, which doesn't have full, you know, full transparency in terms of what's backing it. It's more, you know, it's more resilient than any algo stablecoins or synthetic stablecoins.
Yeah, sorry, I just want to add that it could happen in a secondary market that people are trading ZUSD for less, but then you can just always go, like, acquire it for less, go to the protocol, and exchange it for $1 worth of Bitcoin.
Yeah, I'm just wondering who that person, I mean, I think I do know the answer to this question, but I'm mainly asking for, hopefully, to elicit an answer for the benefit of the audience. But I'm just wondering, why would someone buy like, if I've now been issued this ZUSD, what's the incentive for somebody else to take that ZUSD from me and give me a real dollar for it? No one here can use its ZUSD on its own. But there is someone, obviously, another market participant somewhere in the system that is using that ZUSD for some purpose. So what to them makes the ZUSD worth as much as a real US dollar, such that the whole thing works, such that I can ultimately, indirectly use these loans to buy things in the real world?
Well, yeah, so again, at any time you can grab some ZUSD and get $1 worth of Bitcoin out of it.
Oh, I know. I'm just wondering
in
why.
the protocol.
That's why he's explained. That's how you actually get the value from it.
Yeah.
Oh, I see. Gotcha. I'm with you now.
Yeah.
Yeah. Okay. Fine. Yes.
Like 50 cents on the dollar.
Yeah. Okay.
You take out a loan, you get.
So the reason why the ZUSD is because somewhere on the other side of the contract, someone else can use that ZUSD to buy Bitcoin back. Is that?
Yeah.
To get the Bitcoin out of the loan.
To get the Bitcoin out of the loan. Yep. There we go. Makes sense. That's the answer. All right.
And, yeah, there's also another use case that we haven't got into it. I'll just quickly mention it, that if you go down here, you have the stability pool. So basically you can deposit your ZUSD there, and when somebody else's collateral drops, your ZUSD liquidates their collateral, and you make around 10% profit in Bitcoin.
Yeah.
So that's another use case.
I think it's important to bring this stuff up because we don't want it to look like a free lunch. There has to become kind of downside.
Yeah, no, it's very important. I haven't gotten the questions. So we had more questions, right? You have a question?
Yeah, what if the website goes down?
Yeah. Good question. Rivers, what if the website goes down?
Well, we'll bring it up, you know. The reality is, you know, that this is still, like, we were building Zero also as the SDK, and for people who are more technical, you'll be able to access that without the website as well. Website is just a front end. It's just a front end layer that's you know, it's user friendly. To be honest, right now in the alpha version, I think it was still a bit clunky, but what Thomas mentioned, you know, we'll be launching the new version of the dApp towards the end of the month, and this will be way more refined, way more intuitive, and yeah, I think easier to use. So I mean, to be honest, our website hasn't gone down, and if it did, there's still ways to interact with the protocol.
Can you just save the page, like save page as?
Can you just save the page as?
I haven't tried that. I don't know. Potentially, we should try that. Yeah.
I mean, presumably the smart contract.
You should do that. Like, you absolutely have to. Like, it should be on GitHub, the website, right? You should be able to just download it and run it yourself.
The other protocol from Woodstock already put their website in IPFS, so that way it's much harder to take down.
I mean, if the unlikely event the website did go down, the smart contract is still going to be running on the block. It'd just be a matter of somebody else putting up another interface. It wouldn't even have to be sovereign. It could be anyone who's got the ability to use an interface with it.
It's open source.
That
front end.
Is that right? Is it open source?
The front end.
The front end? Is that? That's
yes.
the question.
Yeah.
It is. There you go. All right. It's open source. All right.
Ideally, a lot of people won't even interact with the protocol directly. There could be people providing services using Zero in the background as well. Any other questions?
I think, if I may, I think you know, what we're putting a lot of focus on. Obviously, you know, we do want to monetize on that somehow, and so I'll tell you how, like, what the plan is. The plan is to build, you know, actually we were already building a Zero SDK, which will allow third parties to integrate in their own platform. So all the financial institutions that would like to embrace Web3, decentralized finance, and have the ability to offer people, you know, the ability to open the lines of credit for themselves, whether it's KYC or not, you know, none of our business. We're doing that as the SDK. There will be an option to add that to third-party software, and then, you know, we will have the origination fee for the sovereign treasury. So that's the main reason why we decided to build on top of that. Another thing is that Zero, you know, is the foundation. That's how we designed that. But, you know, it is very likely that it will be more than Zero. There will be some APY applied to the interest, well, to the loans, and at this point we say, you know, we've built the protocol, we've tested it, it works smoothly, it attracts new customers. We now have I think around 700 Bitcoin locked in, without really, you know, having any massive marketing. and having a wait list. So it's pretty much a closed version, which we're now opening. In terms of the future, we put a lot of focus on the SDK to move forward.
All right, just hold on 1 second. Yeah, technical difficulties here.
There we go.
All right, fixed it. So, questions, all right. We got two. You go first.
Okay, so this one is like a beginner question. Why is there an actual use case, or why do you need ZUSD in order to lend the Bitcoin? Like, why do you need a stablecoin for it, and why don't you get Bitcoin back? You know what I mean?
Yeah, just give us a different Bitcoin. Why
give us a different Bitcoin, because what you said.
I think I can.
So you wanna put your Bitcoin as collateral to get Bitcoin out?
A different Bitcoin, yeah. So our coin isn't sold, you sell it different. You provide us with a different Bitcoin.
Because it's running on rootstock. It's not. This doesn't run on the Bitcoin.
You can also do that, but it's not useful.
It's.
Yeah, I don't see why you wanna borrow your Bitcoin out of your Bitcoin.
What about why can't you bear the risk of holding stablecoin over an extended period of time and provide us with native currency? My question is, if we deposit Bitcoin and hold it there for an extended period of time, it's got the exposure to the stablecoin over that period of time. And what we've seen historically is that stablecoins are stable until they're not, and that's a significant risk. There's companies like Strike that are building on actual layer 2 Bitcoin, and they're providing actual native currency. So they go through the regulatory burden to deliver native currency. So why can't you guys bear the burden of the stablecoin exposure?
Yeah. I think when you do that with Strike, you don't have your Bitcoin, right? You're exchanging your Bitcoin for the stablecoin. There is another protocol on Rootstock that does that. This one is if you want to keep your Bitcoin. So you're borrowing against your Bitcoin, you're not trading your Bitcoin for a stablecoin, if it makes sense.
So I'm going to say the other answer to the question of the stablecoin. Personally, you don't necessarily have to maintain exposure to the stablecoin. The whole point of this is that you're going to put the money into this that you need to actually spend. So you wouldn't necessarily keep holding the stablecoin. It'd be very temporarily you'd have the stablecoin and then convert that to Bitcoin on the exchange or spend it because that's the whole purpose, right? You're not doing this just to hoard a stablecoin. You're doing this because you need money to spend.
Yeah, precisely.
Just wanted to ask about decentralization and what makes Sovereign and maybe Rootstock decentralized. So I know you said that it gets merge mined, and maybe all miners do that. But for everybody running a node, which I assume everybody here does, Bitcoin node, is there a Rootstock component that runs in parallel? How do you send? And if the government then says, well, actually no more ZUSD, it's money laundering, turn it off, can it be turned off?
Rivers, do you want to answer that question, or should I?
Did he hear it?
I didn't hear that 100%. I think the question was around centralization. What makes Sovereign decentralized?
Yeah, and about the Rootstock nodes and whether or not the government could shut it down if they decided to.
Okay. So it's. I think it will be a little similar to, let's say, Liquid Network, where you have a federation. Except in Rootstock, you can actually decide. Well, anybody can decide to run a node. So in Liquid, I think it's just Blockstream, whereas in Rootstock, anyone can just spin a node, RSK node, and then contribute to the network. In terms of Sovereign, we are a distributed collective. We built the software as open source. Any smart contracts go through auditing, for audits, in this sense, we're decentralized. We're running a DAO effectively. So anyone who holds SOV tokens can participate, can vote, and make proposals for the future improvements or new products, etc. In this sense, it's decentralized. What personally what I like most about Sovryn is that it holds privacy at its core values. So we'll never ask you about your passport, your nationality, whether you're from Australia or Afghanistan. It doesn't really matter. That's the way. That's the kind of value that was at the heart of designing Sovryn to make that KYC free, and we intend to keep it that way. There are some plans to, I'm not sure how much I can tell you, but I'll just mention that we're in conversations with banking as a software initiatives that would effectively help us create Sovryn Bank and allow us to go directly from crypto to fiat world without KYC.
Yeah,
there are
it's not going to happen, mate.
limitations.
It's not going to
It's not
happen.
gonna be,
You're not going to do it without KYC. You're not going to get any national currency without KYC.
Well, in Switzerland, up to 1,000 Swiss francs, you can.
Okay, well that's $1,000.
Yeah, it's $1,000 for
Yeah.
many people. $1,000
We're
is.
talking $1,000. That's not real money.
Sorry.
$1,000 is not a lot of money for people that are sitting on Bitcoin wealth.
Yeah, well, $1,000 per day.
Yeah, I know a lot of people in my country that $1,000 would make a big difference.
Guys, we're talking from position of being privileged in this world. Australia or UK, we're doing pretty well. The rest of the world, not necessarily.
So, quick one on the ZUSD. So, if I return the ZUSD, this ZUSD is burnt after I set it back, right?
Yes.
I'm sorry, I didn't catch that?
He's asking, like, once you repay your debt with your ZUSD, those ZUSD get burnt, right?
Yes.
Yeah. Any questions or inquiries?
I don't know if we got answered with the ZUSD. If the government wants to seize that and you're in possession of that, you're still in transition to convert that to fiat. Could that be? Is that confiscatable at any point? Is there risk of that?
They're asking if there is any risk of the government seizing your ZUSD. I think if you keep your keys, and you do your own due diligence, I think that would be very, very hard.
Yeah.
The question is, can they seize your bitcoins that are held by the rootstock? That's the difficult one.
No, because the only way to get your bitcoins out is with your signature of your own wallet.
The private keys that only you still have, right?
No, but they can take the whole rootstock. They can rug pull the whole rootstock.
I recommend there's the guy that is one of the main people that designed the system. He's called Sergio Lerner.
Yeah.
I can show you some videos, and he talks a lot about this and a lot about how they prevent that from happening and future plans to make this even harder. In one of his recent talks, he even was talking about designing a very simple device that you can plug into your computer, and then you become a member of the federation as well, to have just as many people be part of it as possible.
That is a good point, though. What happens? I mean, this is unlikely, but what happens in the instance of as Lloyd said, that you rootstock itself gets rubbed one way or another? What then happens? You've still got the keys to your original Bitcoin.
No, you don't. Rootstock on the Bitcoin blockchain.
Rootstock have the key, right? So
yes, but
no, I'm not saying it's likely.
No,
I'm just like if the hardware is compromised, or was a rug pull from the beginning, right? Because the hardware, you don't need, how do you verify?
Would that
hardware is
the hardware is open source.
But I cannot verify any particular piece of hardware that any of the guys is running is in fact the hardware they think they're running. It's not possible for me to physically go there and see it.
Right. Yeah, I guess.
I'm glad that you worked like there. It does add confidence that you thought about this and were willing to design a particular piece of hardware to ensure your network's secure. That does it does count for something, but obviously there is still the only way that you can have Bitcoin without any counterparty risk is on the Bitcoin blockchain.
Oh, of course.
But we isn't to say that your project is not worth it. It could be very worthwhile. Probably in the way of the future, a lot of things will be designed like this. So
it's a very important point to make. Like you'll never get as much security as holding your own Bitcoin in your hardware wallet. That is just not possible. So I see Rootstock as a way to get more use cases, but it's not where I will keep all my Bitcoin all the time. And like I said in the beginning, the direction the project is heading is to eventually get to a completely trustless bridge. That's the ideal situation. The federation was the best we could get to that stage in the technology we have now.
I think a lot of these questions are pointing. More to the general principles of Rootstock rather than Sovereign specifically now. Because that is an interesting point. Like what Bitcoins, as far as the Bitcoin blockchain is concerned, as Lloyd said, are essentially now seen by the Bitcoin blockchain as having been sent to some sort of Rootstock
to a federated custodian.
It's a federated custodian, right? Yeah.
But it's worth to know that the federation has no ability to take the Bitcoins. The most they could do would be to shut it down and the Bitcoins would get stuck.
Assuming, under certain assumptions, under assumptions about the integrity of the hardware.
Yeah, but it's all open source, it's being audited, it's going to be
there's no way for me to verify, right? Don't trust, verify, not your keys, not your coins.
Right,
That's the two things, right? So it's not my keys, not my coins, and there's don't trust, verify. There's no way for me to verify. Now, I don't believe in those principles 100%, like, you know, religiously. But
you also have dollars in a bank, you know, and can we verify that?
Totally, right. Yeah. So but I think your point is that it's not for holding your coins, Rootstock. It's not for your cold storage.
It's for specific use cases.
It's your hot coins that you're using for something.
Yes.
Like your colleague mentioned.
Guys, you know, Rootstock has been created with the idea of bringing the idea of smart contract to Bitcoin, and you know that's what we're doing. That's what pretty much all the projects on Rootstocks are doing. And again, you know, unfortunately I need to wrap up at this point, but I'll just finalize with you know my sentiment towards DeFi and towards Bitcoin and the whole cycle waves. We're at the stage where, you know, the words like DeFi or NFTs or, you know, anything you can do on top of Bitcoin are not very popular. There are a lot of people who are focusing on just hodling and accumulating Bitcoin and holding that in their cold storage, and there's nothing wrong with that. However, there are other people who want, you know, who have a higher risk tolerance or different life situation, and they need to have tools to use the value of of their holdings. That's why we build stuff like Sovereign. At that point, I'll just reiterate what Thomas said earlier. We will be launching the DApp 2.0, the new DApp for Sovereign Zero towards the end of the month. And we'll be launching that on testnet. So if you want to just come and have a play, you know, without any actual assets, you can use test RBTC to play with the DApp, see, you know, what your experience is, what you think about that. And if feedback is most welcome, we'll be learning from that as well. Yeah, you know, I will leave you in the capable hands of Thomas, and it's been a pleasure talking to you guys. I got to jump on another call.
No worries, thank you.
Yes, viewers, thank you so much for your time. Yeah, and I don't know if there's enough interested people, we could maybe bring someone from Rootstock to talk more about that part specifically. I don't know if there's any more questions or.
I'll ask a question quickly now. So when shown as the fan and the total collateralization ratio goes to 150, so everyone who's under 150 gets liquidated.
No,
yes.
110.
So
It's
No, no.
150 is recovery mode.
Yes, once the
Yeah.
total collateral ratio drops to 150, then people that have 150 or less will get liquidated,
Yeah.
but they only get liquidated 110%.
Yeah.
Yeah.
So what happens to the other 40%?
They will appear here, and you'll have 0 debt here, so you just
Okay, so
just
that's
take-
still at 40% of their Bitcoin.
yeah, yeah.
And then that liquidation 10% profit, the origination fee goes to, was it the 40 founding members?
No, the liquidation fee goes to the treasury of the protocol to keep funding,
Oh,
and it also goes at a percentage goes to the people that have the sovereign token and are staking it in the platform.
yeah.
So
And-
ideally, that will be the community itself.
And then the whole 10% of liquidation goes to those guys that are staking as well?
No. The liquidation goes to the people that put their SetUSD in the stability pool, because that's what the mechanism for liquidating is. You put your SetUSD in the stability pool, and when someone gets under the collateralization ratio, you close their loan and you get the Bitcoin.
Last one real quick.
Yes.
Is there a way we can verify that it's going to go into the platform as safety mode? How would you know it's going to happen?
Well, here we have all the information transparently of how the platform is doing right now. So right now it's in 190.
I understand that, but is there a code base that we can look at to see that until it because we don't know until it happens, right?
Right. So yeah, you can go into the wiki section. Is a lot of detail. I recommend if everyone is gonna use this platform to read the wiki first. It's very in detail, and you have all the contract addresses there to check. They are being audited as well. Personally, I cannot corroborate myself because I'm not a developer, but there are people that are trying to do it. We haven't got into safety mode yet, so it still remains to be seen how it will actually play out. But the contracts are open source, everything is out, and it's being audited. So far, so good.
This is a proof of stake system, so what's preventing you from changing the rules of the system or moving the goalpost with the collateral ratios and anything else? Like, you can change any of the rules. There's nothing really to prevent you, is there? The stakeholders get to vote, and they decide on what any changes that you're going to make within the company.
Yeah, it is a proof of stake in the sense that you need to stake your tokens to participate in the voting mechanism.
Yes.
When you stake, you also have to lock them up for a certain amount of time, and the more time you stake them, the more voting power you get.
You cannot rug pull everyone. The stakeholders cannot rug pull everyone. Surely there's no, like, we all voted to rug pull everyone. And take the money ourselves. But surely that's not
majority
stake. Come on, Thomas, tell me it's not in there.
Yeah, but Lloyd, what if there's a majority stakeholder that wants to rug pull everyone?
That's what I'm saying. I mean, they cannot. The stake, I'm hoping the token is just like we get to vote on like who gets the contractor, who approves the website or whatever, you know, not actually.
I think it's pretty clear. I don't think any of us are in any doubt, even Thomas and Rivers, that there are obviously centralization points still within this. The question perhaps is, if you're in need of a product like this, and not everybody is, and perhaps it isn't for everybody, then be careful not to compare the perfect being the enemy of the good.
Yeah.
Now I sort of set the scene earlier on with what the alternatives were if you did want to borrow against the value of your stack. And as you saw, those are far more risky, far more expensive, far more centralized. But at the same time, I think it's fantastic. It's what we want to do at this meetup, is make sure that we very rigorously flesh out all of the potential problems, such as you mentioned, risk of rug, because we've just seen that happen in crypto. We don't want to see that sort of thing happening in Bitcoin. And so I think that whatever is, I can say I think this has potential. I think people should take a look at it closely, use it very cautiously if you are. Yes, you are essentially, it seems you are locking your coins up in rootstock, and yes, I suppose there is the potential for, but again, you're not doing it with your whole stack. It's not like, again, something like with Ethereum. If someone decides to be in that network, then they're owning Ethereum. All their money is as Ethereum, and literally their entire thing is locked up in something that can get rug pulled by a small group of people. Here it's like, okay, you've taken a loan, And what are you going to lose? You're going to lose the difference between what you've, and this is in the, you know, in the extent to which there still is some chance of a rug pull of some kind, which is, I think, a lot. I'm confident from what I've seen tonight is a lot less than what it is with the other possible mechanisms for doing Bitcoin collateralized loans. But the exposure is really only the difference between what you've put up as collateral and what you've actually already spent and taken it out of the system. So it's an improvement. Can it be decentralized further? We'll see. I don't know. Perhaps there is more work to do in that regard.
I think so. I hope it continues on the track that it's already on. And I invite, like I said in the very beginning, I invite everyone to come to the channels and ask all these questions, because we need the community to be involved if we want to build.
The thing is, people are going to build this stuff on Bitcoin whether we like it or not. The question is whether or not we, you know, have a say and look and see what's being done and really rigorously interrogate what's being done and judge it for what it is, because that's the thing. And of course, what do we want? I think, in my view as well, anything that brings more people into Bitcoin, brings more value into the Bitcoin world, is ultimately good for Bitcoin. You don't have to use this stuff to still benefit from it in that way. Even if you decided that you're not interested in taking even the slightest risk in tying up any amount of your Bitcoin in order to borrow against it, if this meant that you've now got more people entering into Bitcoin because they can now do these sorts of things that they were otherwise running off into very centralized Ethereum to go and do, then that helps the value of your own whole hodled Bitcoin. So that's I think that's all I'll say about it for now. I think what do you?
I think we. I don't know if there's any more questions, but
Yeah.
Yes.
I wanted to know, how do you generate the ZSUD if nothing's happening with the Bitcoin? Because if you get the Bitcoin,
yes,
nothing's happening. You're just holding it, right? Well, why would you give someone ZUSD if you're just holding it? Just out of liquidation sakes?
Yeah.
Sorry, would you mind rephrasing? Just say that again.
Where's the USD seems to be magically appears, right? It's
yes.
like I've got Bitcoin now.
You are minting it in the in the rootstock smart contract, correct?
Yes. What it is though is you're taking a leverage long position on Bitcoin, right? That's the key thing to understand.
Yeah.
And you're getting this US dollars, okay, as the short side of that position. Okay, so it's like I'm long Bitcoin on this side, and I'm shorted on this side, and so I'm even out.
Yeah.
Okay.
So the benefit is basically for the company, if someone gets liquidated, they take the Bitcoin. And that's the only benefit, or
the company does not participate in the liquidation process. Okay, so
that's purely now autonomously on the smart contract.
Yeah. So you as a user can participate in the stability pool if you want, or not. But the users are the ones that are doing the stabilization and profiting from it. The project, the protocol, only benefits from the origination fee. Yeah, and about the question about the ZUSD appearing from nowhere, if you think about something like, you know, like the banks when they had gold reserves, they put the gold in the vault and they give you token.
All right, if that's yeah,
it's that, but you have your own vault, and it's transparent and you can see through it, basically, with Bitcoin.
Well, if that's all of the questions, obviously we'll stick around. I mean, Thomas, you're going to stick around for a bit longer. Are you going to rush off?
Until the last person leaves.
Good. Because we've got this room as long as we want it, and which raises another point. I'm trying to get this as our venue going forward for the second Wednesday of every month. So I'm very pleased with the turnout tonight. I think the hotel will appreciate that, because obviously, you know, they're running a business. We need to give them make sure that they see the value in giving us this room as opposed to giving it to other groups or running, you know, stand-up comedy nights or whatever other nonsense they've had on here. But as long as they can see us getting, so it's important, as long as we seem to be supporting the hotel, people buy a drink, buy a meal, they're happy with us being here, they'll give us this space, because I think we've had our meetups here a couple of years back, and I think this place always worked out the best venue for us for this sort of format. It sort of ticked all of the boxes. So, yeah. So stick around, buy a few more drinks. I think the kitchen's probably closed, but otherwise, yeah. thanks for coming out tonight, guys, and we'll have drinks in 2 weeks' time at Club York, as usual. So we're going to try to have that. We're not going to try, we're going to just do it. We're going to have it on the 4th Wednesday of every month at Club York. So 2nd Wednesday here, 4th Wednesday just for drinks at Club York going forward. Keep it regular so everyone knows in advance they can, you know, get the leave pass from the wife or whatever the situation is to come along here. So thanks for your attention tonight, guys. Thank you for Thomas. And that's right. That's right. You're always going to get far more yes, exactly. I want to see